Welcome to the panel discussion on private credit and yield, the topic of tonight. Private credit has been an increasingly popular asset class due to its combination of yield, security and stability. It's been a hot topic because it's been forecast to grow both in performance and size, though some are calling for a bit more scrutiny on the industry. My name's Frances. I'm a co-founder and director of Capstone Funds. We're a boutique real estate debt fund, and I'm humbled to be joined by some very distinguished fund managers in private credit and in property tonight. I'd just like to invite each of you to introduce yourself, starting with Mike.
Okay, sure. Thank you, Frances, and good evening, everybody. It's nice of you to be out at this time of night to listen to us, so thank you. We've been operating in the private credit markets as we've defined them for the past 20 years. Private credit is not a new asset class per se. It's been around for more than 400 years. The Medicis have been doing it in Italy for that long. And so what we do is in terms of our businesses, we lend to growing businesses. So we're lending to the kinds of businesses that perhaps some of you folks have made your own money out of, and you understand the risk-reward profile of doing that. I'll leave my comments there and we'll get into it later. Thank you.
Sam Sproats is my name. I've had the opportunity to speak already. I'm the head of funds management at Growthpoint Properties Australia. We're an institutional real estate investment manager trading in Australian assets across the country, and very pleased to be here.
Hi, good evening. Scott Gerard, Director from Sterling Property Group. We're principally a real estate equity investor focusing on value-add opportunities across the Australian eastern seaboard. My background is both in real estate, debt and equity. So thank you for the opportunity to sit on the panel this evening.
Hi, I'm Chris Broad, not the former England cricketer. I also appear to be wearing exactly what I was in my mugshot. So it's my birthday next week, so I'll see if I can get a bit more in the wardrobe. So very briefly, myself and two partners in Sydney and Melbourne, we co-own a fund with Greg Paramore, who has been mentioned by Steve at the outset. So Greg will not mind me saying he is a veteran of the property funds management industry in Australia. Most recently, he sold a business called Folkestone Property Group to Charter Hall. He sits on the board of Charter Hall. He also sits on the board of the Sydney Swans, so at the moment he's very happy. And we basically concentrate on development finance with ticket size up to about $15 million. Greg, through one of his other entities, co-invests in our product offerings, and we focus purely on debt, but other parts of the business in the family office play in other aspects of property development finance, including equity, but we don't mix debt and equity.
Great, thank you, and happy birthday for next week. Now, Chris, I might start with you. Private credit is booming and seems to be in the media every day, which I think someone said is surprising for the asset class that it is. What unique opportunity does it provide to investors?
Well, I think there's a couple of thematics here at the moment. One is, the best competitors that you could wish for at the moment are the banks. Really, they just create huge opportunity for people like ourselves in the non-bank lending space, filling up a vacuum that they've left, particularly in development finance. I think the thing also to remember is we tend to tagline this with property, but property is really the security that sits behind the product offering. You got to remember this is a fixed income product at the end of the day. You're investing investment principal, you're earning a yield, and ultimately what you're really banking on is the fact that you'll get a return on that investment, but ultimately the security behind it is a mortgage over Australian real estate. And as a security, one of the sort of unique factors of property in Australia is you can get other asset classes like crypto, like small cap stocks, and the volatility in their pricing or the value in those can erode very rapidly. Australian property is incredibly robust. So when you see downturns in Australian property, you talk about single-digit downfalls or teen-level reductions in asset values, really nothing less or nothing more than that. The other overriding factor is that not only are you protected by downside risk on the underlying asset value, but also you've got this loan to value ratio that you're applying to your debt. So you still may be no more than 65, 60, 70% of that total asset value. So really you've got a very, very strong risk return thesis, and people are seeing that as an attractive aspect in their asset allocation. Yeah, but bear in mind it is a fixed income product. You are part of a lending product. You are not directly owning property.
Great, thank you. And we've just heard yesterday the RBA doesn't have a rate cut in sight, so certainly high interest rates are to stay for now. So I'm interested in your perspective, Mike, in this environment that the cost of capital has changed and therefore so has returns to investors. What should investors be expecting in terms of yield adjustments from this high interest rate environment and risk?
Yeah, well, I think we've probably already seen a lot of that happen, Francis. I think everybody's well aware. It's amazing how much the general public watches the RBA. I've been in debt markets myself for more than 30 years, and once upon a time I used to think that we were the only people who talked about it and watched it. But anyway, I think in terms of rates, to answer the question, and I'm not about to predict where rates are going to go. We've seen what the US Fed did, and we saw rates here in this country and in most Western democracies move up much faster over the last 2 years than they ever have in history. So you saw a big or a significant adjustment in terms of the cost of capital, both cost of debt capital, cost of equity capital, and everything else. And I think what's important then, and most of all the panel members to my right would be well aware of this as well, is that when you go in and price risk in an environment like this, you need to price it with a long-term mindset. There's no point in pricing it based on what interest rates have done over the course of the last couple of years in what has been an unrealistic environment. So certainly when we look at pricing opportunities in the businesses that we look at, the sort of return you should be getting at a senior secured level in what we do is in the low double digits. It's always been that way. That hasn't changed. So when interest rates, or base rates as they call it, or the RBA cash rate was near enough to zero 2 years ago, we were still writing loans at 13 and 14%. Okay. Now, a lot of lenders do have the opportunity, because they lend on a floating rate basis. Of course, they've drifted up with the way rates have moved up, and that's been an important feature for some funds. I think what's important, though, regardless of interest rates, is that based on the exposure you're taking, you're getting paid for the risk that you're taking.
Yeah, I share that experience in my fund. We've been relatively inelastic to the underlying cash rate, which has been interesting. Now, Scott, I'd like to also ask you, with your over 20 years experience in both property and fund management, and we've had discussions tonight about both property and private credit, how should investors be thinking about private credit versus property investment?
Yeah, I think it's interesting in Australia, if you have a look at the global institutional market and picking up previous comments, that real estate-backed debt is really viewed as a fixed income product. I think what we've found here in Australia in the wholesale market in the last 24 to 36 months is it's been positioned relative to a proxy for real estate equity investment. And I think there's probably going to be a divergence between those views as direct real estate assets reprice and offer better attractive returns than probably what we've seen over the last 2 to 3 years, where pricing has really struggled on the direct side with interest rates resetting. So it will be interesting to see how it sort of plays out as the market matures in the wholesale space in Australia, an asset allocation around real estate debt with respect to a fixed income allocation as opposed to a real estate equity allocation. But I think, again, it's relatively in its nascency in terms of capital flows going into the sector. The sector's been around for a long time, but really the rates and the returns that have been on offer in the market over the last 24 to 36 months has probably seen a reallocation out of real estate equity into real estate debt. It's how sustainable that is relative to being a fixed income product. And I think that's what's going to be interesting, as I said, as real estate equity reprices and offers mid-teen returns in a falling rate environment. It will be interesting to see how investors sort of play that interplay between debt and equity on the real estate side.
I think that's a really interesting point. I'd love to come back to diversification. certainly private credit has been really popular as a diversifier, as uncorrelated to public markets. So I've certainly seen that globally as it come in as a greater stabiliser when the equities markets have been nothing short of volatile. But let's come back to that nugget. Before we get there, Sam, you're involved in direct property. So I'd love to know, from your perspective, what are the specific segments where you're seeing the most yield in your market?
Thanks, Francis. I'll put my investor hat on, my private investor hat on, I think, to answer that. What we believe you're after from an investment perspective is access to commercial real estate. You want access to investments that have re-rated. So Scott touched on that. I mentioned it before. The adjustment in price. So you're coming in at a very compelling entry price and you can see what the pathway is forward. But from a private investor, you have limited capacity. And so you want to align yourself with an investment manager and managers that can access those opportunities. The funds management business, has been around for 31 years and over 100 transactions in that time. And that is what we offer up to the private wealth investor group. So it's a re-rating of the market. Markets move in cycles. I touched on a counter-cyclical view previously. But you want to be able to move in and out of, or buy and sell in and out of cycles as well. The return profiles, if you can buy well enough and be patient to buy well enough, are very attractive to investors. I think from Scott's comment before, I'd say there's definitely a place for both private credit and direct real estate in the market we are in and going forward. The banks are not changing their attitude. So the private credit space is definitely well received from a private wealth and how they wealth investor group and how you can participate and get access to those opportunities. And then on the direct real estate, we're specialists in commercial real estate. The sectors that we would focus on would be the typical, the traditional food classes, industrial, office and retail and mixed use. And an example of that, and maybe from our own neighbourhood in a way that's a local asset, but Camaret Square, surprisingly at Camaret, but Camaret Square is a mixed-use asset. Most would know as a retail asset. And we like property like that has a diverse income stream, multiple different sectors in. So in that, it's underpinned by a supermarket and it's got a lot of specialties and childcare, commercial, medical centre. And those opportunities, $50 million opportunities, needs a lot of capital and the right level of gearing as well to get access to those returns. That's a nice example of an asset that we own, that we continue to target. Someone mentioned before, like, where do you want to invest your real estate? I would most definitely be saying it's across the eastern seaboard, up and down the coast. Queensland's a very, very interesting place at the moment. Property growth, affordability, infrastructure spend, and we might even have the Olympics if they can build everything needed for 2032. Queensland's a market that we are keenly focused on. Likewise, in our own backyard, Sydney, New South Wales, but certainly up and down the coast.
I think that's been well proven over the last 30 years of growth on the eastern seaboard. Absolutely. Now, I'd like to move back into that point around diversification and the role of private credit and property in a diversified portfolio. Then I'd like to move on to discussing the risks, as we should all be aware in any investment. So, as Scott, you mentioned before, private credit is often classed as a fixed income product. And over the last few years, it's really risen in popularity as a diversifier in portfolios because it's stable, it's uncorrelated. And some are even calling for this alternative investment asset to become the mainstream. I think KKR, an American firm, have actually recommended it should be 10% of everybody's portfolio, which is quite bold. So, Chris, I'd like to ask you, how do you see private credit setting in investors' broader strategy in a volatile market?
I think, to Sam's point about choice, you've really got those opportunities in longer-term investment asset holds in property. On the private debt side, you can really kind of slice and dice this and actually pick out of it what you really want to choose from. So people love to talk about the property market as some kind of amorphous generic thing, and it's just so far from that. It's Certainly in the development cycle, you're really going from sort of the planning land stage into construction, into completed assets. So you can make choices about where you want to be in that area. We have investors who want to play in land but don't want to play in construction. Some people want to play in construction because one of the speakers also talked earlier about a lot of land loans just really coming to maturity and then not finding a new home and moving into the next stage of the gears. One of the things that we really like about construction lending is that there is a proof point from an exit perspective. And if you know how to manage risk and you know how to manage construction process and you've dealt with all the things that can possibly go wrong, then we actually like that area. Other diversification comes through geography. We touched upon Queensland. People can be quite parochial about where they want to invest. They want to be able to drive past that site and see it in action. Other people are a lot more agnostic about that. Then you go into a layer where there are various property sub-asset classes. So, our chair and co-owner, Greg Paramore, sold a large childcare property portfolio to Charter Hall. That's one asset class in its own right. You then go between residential and commercial. Residential, I think, is pretty well documented, but commercial really comes down to the quality of the lease covenant and the tenant at the end of the day, because it is a specialised asset. Childcare, you need an operator. Warehouse, you need somebody there. So you've really got to look at the quality of that operator at the end of the day to identify where the value in that asset is. And finally, I think the other thing is loan tenor. So duration risk. Everything that we do, we chop. If we are in a land loan and then we go into construction, there's a liquidity event at each phase, because we believe the characteristics of the risk change, and it does give investors the choice of when they want to come in and out of those particular investments. So even within this sort of asset class, there's huge diversity even within that people can pick and choose, and we think that's a really important characteristic to add to your offering to investors.
And I think through what you discuss, it really demonstrates the importance of the experience of your fund manager and how they can manage when things go wrong, which does bring us on to risk. I like the comment earlier about investing into private credit being the best risk return that you can achieve. So let's dive into that a bit, as all investments do have risk. And Mike, I'd like to know your experience at managing both private debt portfolios at large institutions and at independent firms. How do you approach balancing risk and yield in private credit?
Yeah, that's there's a lot in that question, Francis. But I think that what any investor should be aware of when they're, as I've touched on before, when you're looking at the risk-reward trade-off in any transaction that you do, and whether it's lending against property-based assets or lending against business-based assets, that what you're doing is getting the right protections wrapped around the loan that's being done. I'm sure everybody on this panel would have in their investment approach what we describe in our business as the 4 C's. So when we're looking at lending to a business, we're looking at the collateral in the business, we're looking at the covenants that we apply to the loan, we're looking at the cash flow in the business, and we're looking at the character of the borrower. And that's a very important aspect of it as well. And those dynamics are actually very important then in determining what sort of risk-reward trade-off you should be reaching. And it then depends what part of the credit capital stack are you sitting in. So in our flagship fund that I talked about before, having a low double-digit return, we're sitting senior secured, so right at the top of the capital stack. So what I mean when I say that is that we're well ahead of equity, and we're getting equity-like returns for the kind of risk that we're riding. So that's what a risk-reward profile payoff looking attractive looks like.
I think I'm going to steal that 4 C's, especially around the character. That's a great catchphrase. Absolutely. And Scott, from your perspective, what do you see as the key risk factors that investors should look at and evaluate when they're looking at investing?
guess from a debt side, it's all about the borrower to a large extent. It's a contractual asset class. The facility agreement, the terms within that facility agreement are hugely important. I think the first movers in the private credit market have done incredibly well to build scale. I'd be somewhat reserved around a lot of the new capital coming into the market, not saying that there's not room for that capital, but as you see more capital coming in, trying to pick up those returns, ultimately returns will come down as new capital bids for business. And one of those areas that can be sort of looked upon to try and win business is a facility agreement and introducing terms that are more borrower favourable than lender favourable. So I think that's a key consideration around risk. Pretty basic around borrower risk, track record, equity, security. It's relatively vanilla. And then you get into sector, geographical, the areas of the market that you're investing into or you're lending into, and then the obviously the geography. But I think for an investor's perspective, when we look at private credit deals now, we're really wary about the amount of money that's come into the market in the last 12 months off the back of relatively high returns historically and pretty attractive absolute returns, and just making sure that the facility agreements are still holding tight with respect to covenants and terms within those, and making sure that they are lender favourable.
What do you think the impact of that new capital coming into market is?
Lower returns ultimately. When you get a lot of supply coming into the market against, a level of demand that is growing, but not to the same extent at which supply is coming into the market, ultimately something gives, and it's typically risk or return. People take on more risk for the same level of return, or they hold their risk profile and accept a lower level of return. And I think that will ultimately, that's where the market will move. And again, the established operators in the market probably have a first mover advantage and scale there to be able to operate off the back of those lower returns.
It's a really interesting point to watch as returns are at an all-time high. Besides the size of private credit is forecast to grow exponentially. I know Pequin forecasts that the performance will continue to grow, but I think you make a really astute point around how will those dynamics in the market change. Now, Sam, you're in a different field than direct property investment, so keen to hear from yourself as well about what risks should investors be thinking of when they're looking at that.
Yeah, thanks. You can never do enough due diligence. You can never, ever do enough, whether or not you're doing due diligence on an investment manager and wanting to support what your investment manager is presenting. You also have the ability to say no, and it's for the investment manager to present the case as to why it's a good investment. If I put on my investment manager hat on one hand, again, due diligence is one of our specialties. We have a saying in the business that well bought is half sold. It's always about buying well, buying for unseen value and creating that value. And then the other point is you've got to be able to work and move through cycles on the real estate front. So we're always very much, we have a 3 C's as well. Our first C is cash flow. Cash flow obviously relates very much to what we're here for tonight, which is about high yielding investment opportunities. But it's complex. And from an investor to presented before, to acquire a $90 million asset is certainly out of reach for a lot of people. And so the way we structure it and create those opportunities for investors to leverage off what is an institutional model. And then, look, risk is everywhere. No investments without risk. So you, back to due diligence, from a manager perspective, it's track record and reputation, and you certainly can't buy your reputation. So that's the opportunity for yourselves to critique that and back the right people.
Great. Well, we've got about 5 minutes left, so I'd like to actually turn to the final thoughts for this evening and the advice that you would each leave for the investors here tonight. So, Chris, from your perspective, When an investor's looking at these plethora of options, what advice do you give them about what they should consider?
Yes, I think we've talked a fair amount about the asset class itself, and we've certainly touched on do your homework on your asset manager, because ultimately they're going to dig you out of a hole if there's a hole to be dug out of. And I can't stress enough the quality of the asset manager, their track record and their skill set around doing that is absolutely tantamount. I think the second factor is transparency. Get comfortable that you can see through that investment and are really clear about what the underlying asset is and what the underlying risks around it are. I think that's there's lots of different structures out there. You need to give yourself enough comfort that you can really understand what you're investing in. I think with the due diligence hat, it's not what you do just at the beginning, it's what you do all the way through. So that due diligence, particularly for the sort of work we do where we actually like construction, but it takes work and it's about putting the canary down the mine constantly. So, in our investor report, we do a page on every loan. There's photos when the last quantity surveyor was last out there, when the last claim was paid, when we were last there. Literally, we put it all out there, right? So I think it's all about understanding who you're dealing with, their competencies, and your ability to look through.
That's some sage advice. And Mike, from your perspective, what's your view on the outlook of the sector and where do you see the most promising yield?
Well, look, I think the sector, we often describe the private debt sector or the private credit sector as a very broad church, and, it covers numerous categories. If you just look at the percentages here on stage tonight, there's 5 of us on stage, and 4 of the 5 of us are all involved in property-based private debt strategies. As I said, we're involved in business asset lending-based private debt strategies. So I guess what I would say, Francis, is that diversification, as everybody knows, is the ultimate free lunch. And if you are looking at strategies that are going to provide income to you, I would definitely be looking across the various strategies. I certainly endorse the comments that Chris made in terms of all of the other due diligence aspects, etc., that you need to be conscious of. But I'd make sure that what you're getting is true to label. Okay, so what they say on the wrapper is actually what you're getting, and that does go to the due diligence on the manager. And I think that if you've got an appropriate mix of those kinds of exposures or strategies across a portfolio, you can build yourself quite a good, income based, whether it's for retirement purposes or ongoing living purposes.
Great. And Scott, your views?
I think there's just a couple of observations. Ultimately, you want to be with a manager of capital and not an allocator of capital. And what I mean by that is ultimately you're going to have some experiences that don't turn out as per your underwriting, and you've got to get yourself out of those as a manager and work ways to get back on track from an investment perspective. Managers get in and do that. Allocators typically observe. So I think it's very prudent if you are an investor to do DD, as Sam said, on the manager and work out what experience they have of working out issues. I think the private debt market, it's been well positioned as relatively risk-free, and no investment earning 10 or 12% risk-free. And so I think it's worth understanding the underlying assets, the underlying borrowers, the diversification, and don't chase excessive yield. Always be cognizant of risk and be prudent in terms of managing that risk, and just be conscious of that.
I think I'm hearing a common theme of DD on your fund manager, but also I think the transparency. I love the sticker on the label should say what's in the box, and then you should get regular updates around that. That's really critically important. So I think, Sam, I'll leave you with the last words for tonight.
Thank you. Last words of wisdom. Be patient, be diligent. be ready to pounce, and markets move, and we're in a cycle right now where we're coming out of the bottom of the cycle. You'll never pick the bottom, and we'll never pick the top of the markets. But now's a very exciting time from a private wealth sense, of where you can get opportunities and buying quality real estate and quality debt products at a real discount or a great return. I think that's what tonight's all about. It's about finding the right high-yielding return for your investor money. And like I think David mentioned it very earlier, capital preservation. Worked hard to make that money, however it's been generated. Don't lose it. Back the right managers and generate some more wealth going forward.
I could not have said that better myself. So I'm right on time, which is incredible. So we'll wrap up there. I just wanted to say a very heartfelt thank you for you all for bringing your expertise to us tonight.